What this chart shows is prices in this chart are the red line here in cents per pound, and what it shows going back to almost a year and a half, back to the summer, the end of the summer of 2014, you've seen that prices have been stuck in a remarkably narrow trading range. From once you get into the fall of 2014, they've basically been stuck in the 60-cent range. That's about 66 cents there, 67, 68 at the highs. They've spent most of their time trading with really between 60 and 65, and here recently they've dipped below 60. We've seen futures prices in the upper 50s. It's not usual that they trade that long in such a narrow range, but what it indicates to me is that there's simply no demand support for cotton prices to trade at the higher levels, because when they get up there, our exports, which is what this these little blue spikes are showing, our exports will drop from 200, 300, 400,000 bales per week. They'll plummet. When we get up to the high end of our price range, they'll plummet down to below 100,000, and that's happened consistently across this time. Every time we have a price peak, basically that says U.S. cotton is uncompetitive, and all of our export business goes to people like Brazil and Australia and West Africa and other places. So there's cheaper cotton. There's enough cheaper cotton that people switch. The other reason they switch is that a lot of the clothing manufacturers have been using more polyester, because polyester is considerably cheaper than cotton. Another reason they switch is because, kind of indirectly baked into this, is that consumer spending is not rip-roaring. The economy is not just booming so that people are being wealthier, feeling wealthier, spending more on apparel. And also, perhaps, and this is scary, consumers may have gotten used to buying clothes that are lighter and have less cotton blended into them. All of that would be kind of indirectly behind this, but it's reflected in the fact that apparel manufacturers, yarn manufacturers, aren't willing to pay any more than that for cotton, for U.S. cotton. And what's also disturbing about that is that none of those things, low polyester prices, which are linked to low oil prices, the growth rate of the economy being kind of weak, consumer spending, all of those things are things that are not going to get corrected anytime in the near term. I mean, I don't see them really getting corrected for a year or for years. So that's another way of saying I don't really see much chance of prices climbing above the mid-60s and being sustained up there, because there's no demand support. The only thing that might push them up there, and it would be temporary, is if there's some kind of a production problem, a scare, we have low planted acreage and the weather turns hot and dry. That might push us up above 65 cents. It might push us to 70 cents. But if it happened, it wouldn't be at harvest time. It'd be in the summer, and it probably wouldn't persist very long. So that's the market we're dealing with. Basically, we're range bound. There's downside risk, as we've been seeing here recently in the last few weeks, and I think we're stuck with that for a while.